For many Australians approaching retirement, investment property has been a faithful long-term strategy. It's familiar, it's tangible, and it's helped build wealth over decades. But as you step into retirement, when superannuation becomes accessible, income generation takes on an increased focus, and lifestyle becomes the priority, it's time to think about whether an investment property or properties continues to make sense. Well, thanks for listening to another episode of the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. Let's dive into this week's episode. When do we sell our investment properties? The retirement edition. So let's start with the obvious. Should I be selling my investment property? We spend so much time thinking about when to buy a property, but very little time thinking about when or whether to sell. And yet the decision to sell, especially around retirement, can have a major impact on your long-term financial security, income stability, and lifestyle options. Retirement transforms your financial priorities. Your income changes shape and your time horizon shifts. Decisions are no longer about maximising long-term growth. They're about ensuring safety, stability, simplicity, and most importantly, adequate income so you can make the most of your retirement years. So here's a few things that typically change. Your income becomes largely fixed. So you've got your superannuation pension, maybe an annuity, could even have some part-age pension. Liquidity becomes a lot more important than illiquid assets. Cash flow reliability really matters far more than potential capital growth. You might prefer to simplify life and just reduce admin and hassle and stress. Estate planning considerations can sort of become a bit more prominent, and you no longer have the buffer of a salary, which can be really helpful in terms of absorbing property costs, especially significant repairs and things that can come out of the blue. An investment property that was perfect in your 40s or 50s might no longer be the best fit once you enter retirement. If you're weighing up whether to sell, these are the most common and perhaps the most compelling reasons why retirees might make the shift. So the number one by far is to boost your super. Once retired, your superannuation savings convert into an income stream, with the income being tax-free, provided that you're within the transfer balance cap. It's tough to imagine a better tax circumstance than 0%. Given the generosity of our superannuation system at this phase of life, it's sensible to endeavour to use as much of this as you possibly can. The current transfer balance cap is $2 million per person. So the optimal position to get yourself into is to have a superannuation balance around this level. If selling an investment property will help you get there, this may well be an attractive strategy option. Improving cash flow. So investment properties can become more of a cash flow burden as you move into retirement. Certainly, the negative gearing type concept is no longer relevant. You want positive cash flow, not negative once you're retired. But with property, there's always repairs and maintenance. And chances are if you've owned this building or this property for a long period of time, it tends to wear out. So there's a possibility that in fact the repair and maintenance expenses increase as you go through retirement, the exact opposite of really what you would want. Insurance costs, body corporate costs, of course, they continue to go up. Land tax, particularly in Victoria, has become more and more significant, but it's applicable in other states, and I'm sure it will grow there too. And rental increases, they don't always keep pace with inflation. So, that can be a bit of a challenge too. Now, when you're working, you can absorb the occasional unexpected cost. But once you're retired, these spikes can cause real stress. Selling can just take the pressure off your cash flow and create a more predictable financial situation for you. Another reason for selling is reducing complexity and stress. Retirement's time to simplify, right? You're trying to, this is your golden years, your period to relax, enjoy, travel, spend time with friends, that sort of stuff. Whereas, of course, owning an investment property, it's generally a bit of an active pursuit. You've got agents, there are potentially periods of vacancy and changing over tenants, but particularly there's repairs, properties wear out, as we just spoke about. There's compliance issues, different tenant needs, that sort of stuff, insurances, these sort of things. So, some people love property management, and if that's your jam, go for it. But for most people, it's a bit of a burden, a bit of a hassle. And if you're in retirement and you're trying to prioritise your health and travel and lifestyle and really making the most of things, then selling a property can really free up your time and your mental energy as well. And the final reason, that you might want to sell is, for a lot of people, it can be the optimal time to trigger a capital gain. So hopefully your property's been successful. I mean, generally in Australia, you hold properties long enough, they tend to increase in value. In which case, there's a capital gain here. Now, through the ownership period to date, you've had that growth, but you haven't had to pay any tax on that, right? Because it's only triggered at the point that you sell, which is great because it means you've got flexibility as to when you're going to pay that capital gains tax. Whatever the gain is, in the year that you sell, that gain gets added to your taxable income in that particular year. And the nature of our marginal tax rate system is, the first 20-odd thousand you earn, you don't pay any tax, and then the next portion, you pay 16%, and then the next portion you pay 30%, etc. So if you can sell in a year where you don't have any other taxable income, probably because your primary source of income once retired is from superannuation, and as I've mentioned earlier and in previous episodes, the income from super is probably tax-free. So if you can trigger the capital gain in one of these years where you've got little to no other income, then that means that capital gain can take advantage of that tax-free threshold and then the lower marginal tax rates, rather than it being put on top of your normal salary and wages income before you retired, where you might already be on the top marginal tax rate, in which case the whole gain, nearly half of it's going to be taxed, right? So doing the sale shortly after you've retired, particularly in the next financial year after you've retired, that can be a really optimal time to minimise your capital gains tax expense and therefore maximise the amount of the sale proceeds that you've got available to then fund your retirement. I've put together a little bit of a framework to help you decide whether to sell. So I've got three questions here. So firstly, is the property helping me in terms of living the retirement lifestyle that I want? I mean, if it's adding stress or restricting you in some way, restricting your flexibility, then that might be a reason to say, okay, let's get rid of it. Is the property cash flow positive after all the costs? So the rent comes in, but then you've got to pay the council rates and all the other bits and pieces. Is it actually generating positive cash flow for you? Because if it's not, why would you own it in retirement? And then finally, what's the opportunity cost? A few episodes back, I did one on opportunity cost, but certainly relevant here. So if you sold this property, what else could you be doing with that money? And I've already touched on a few, but particularly, boosting your super is perhaps the most obvious. But maybe it's about, having more emergency funds. Could be just, simplifying your life. Could be doing more travel, that sort of stuff. So if retaining the property is restricting your options, it might be a good time to reassess. So let's say you decide that you are going to sell your property. The next obvious question is, well, what am I going to do with the proceeds? Now, as we've already touched on, first port of call would typically be try and boost your super. But once we've gone past that, then there might be opportunities to do some investment outside of super, right? Because there's only a certain amount you can get into super. There's contribution limits, as I've touched on earlier. There's a maximum transfer balance cap you can get in. So it could be that when you sell the property, you just can't get all the funds into super. So some of that you might want to invest outside. It could be that you just want to carry some more cash so that you've got money there if you wanted to do some travel or some emergencies or whatever else. If you've still got any debt, a lot of people would want to in retirement be debt-free. That's one less stress. So it could be that selling the investment property is a way for you to become debt-free. You might want to, be able to buy a caravan or a boat or whatever you want to do. So it could be that freeing up the money gives you an ability to pursue some more hobbies, which is then your way of getting the most happiness out of your retirement. And of course, the final one, particularly if we've done financial modelling for you and established that, look, you're comfortable with your assets and actually whether it's all or some portion of these sale proceeds are really in excess of your needs, then there could be scope to do some early inheritance gifts, which can be really impactful. Again, I've spoken about that in past episodes, but when you pass away, whatever's left is going to go to your children, perhaps your grandchildren in some instances. But particularly if it's your children, chances are they're not going to get that until they're perhaps in their 60s themselves. At which point they're probably reasonably financially secure anyhow, and certainly it's not at their peak living cost point of view. Kids are off their hands, that sort of stuff. If it's clear that you have surplus assets beyond what you're ever going to need, then it can be really impactful to do some early inheritance gifts now when you're perhaps in your mid-60s, therefore you're passing it on to your kids maybe when they're in their mid-40s or something, at which point they might have school fees and they've still got a mortgage and all sorts. So the benefit of that inheritance is going to be far more significant than if they have to wait until you pass away. And of course it means that you get to see them, remove that financial stress and have those extra options. So early inheritance gifts is certainly another potential option. But I guess the aim in terms of what you do with the sale proceeds, you're just trying to line up, well, look, this is what I want out of life. This is what I want out of my retirement, and putting the funds to whatever use is going to most line up with that goal. I guess just some final thoughts. Look, for most people, selling investment properties once retired is a pretty sensible strategic shift. It's about ensuring that your assets are arranged in a way that supports you for the next 20 or 30 years of life. Retirement should be a time of freedom, flexibility, and confidence. And sometimes that means acknowledging that the property that served you well along the journey whilst you were working, but maybe it's not the right companion from this point forward. All right, well, look, hopefully that's some useful thoughts for you. Thanks once again for listening, and bye for now.